Hi everyone, welcome to our latest Argent video. We're going to do a series of videos on tax release building up to the end of the tax year, and we're going to concentrate on this one about the importance of pension planning for tax planning, particularly when we're approaching the end of the tax year. So we're each going to talk you through the importance of the need for pension planning and the tax release available. So Scott, do you want to lead us off?
Yeah, cheers Nick. I think the good news to start with is that we are living longer these days. The downside to that is that how many of us are actually funding for that retirement. And obviously we do have a retirement now that could last as long as our actual working career. So it's doubly important that we make that serious contributions towards that. I think also with the pharmaceutical enhancements and the knowledge, people taking more health conscious decisions these days. You know, people are generally improving their standard of living. So it's not uncommon now that reaching the age of 100 is becoming, you know, something that's quite normal. And as you can see there by the slide, gives you the example that a baby born in 2020, the chance of living to the age of 100 has dramatically increased from previous years. This means obviously that with the decrease in babies being born to previous years, you know, in the future we are going to have an elderly generation with a reduced workforce that's able to support them. So when we look at the state-based pension contributions that we get, you know, that's going to that's not going to be enough in the future. So it's doubly important that we make these contributions, and not just for ourselves, but for our children that are coming up behind us also. Cheers, Nick.
Sam, you're going to take us through the next section.
Thanks, Scott. Sorry, had a bit of a technical issue there. That was brilliant. It's good to see we are an ageing population. Now, you might think, well, okay, I need to plough as much as I can into my pension. Well, unfortunately, as you can see from this slide, the amount you can actually pay into your pension each year has been dramatically reduced. In 2010-2011 tax year, you could pay just over £250,000 into your pension. Over the time, governments have slowly reduced that. So you can't just plough in everything you need. So you need to do careful planning to ensure that you don't exceed these allowances. In the current year, you can pay up to £40,000 into a pension and get tax relief. However, that may be reduced if you're a high earner. So people with earnings in excess of £240,000, give or take, there are some slight nuances in there, can have that annual allowance reduced down to £4,000. So it's really important that you speak to an advisor so you know how much you can actually contribute to a pension. If you do go above that, there are some rules called carry forward. So you can go back to the last 3 tax years, so you can mop up unused allowances from the previous tax year. So it's a really good opportunity to maximise what you can put into your pension and get tax relief. But there are rules around that, so please do speak to us if you wanted to look at maximising that. As well as the annual allowance, you've also got a lifetime allowance of how much you can pay into your pension over the whole term of your living. And again, as you can see, from 2010 down to the current tax year, that's reduced dramatically from 1.8 million down to currently where it's sitting at just over 1.07 million. Now, this is increasing each year in line with inflation measured by CPI, so it is going to slowly go up each year. But again, this is something you need to make sure that you're taking into account when you do save into your pension, because it does limit what income you can get out of your pension when you retire. For example, that pension pot, if you retired today at the lifetime allowance of just over 1.07 million, if you took a 4% withdrawal from your pension pot, that would equal an income of just over £42,000. So again, that is quite a healthy sum of money, but it might not be enough for some people. So if you're planning for your retirement, you need to really carefully plan where you're going to get your income from to make sure that you do have the retirement you want, and the income that you receive will last you throughout your whole retirement term. So I'm going to pass back over to Nick now, who's going to talk a bit about the tax reliefs and the other benefits of investing into a pension.
Thanks, Sam. It's true that tax relief on contributions still remains the the most valuable tool when it comes to pension planning. But over recent years, there have been some other benefits as well. We still get tax efficient growth within a pension plan. That hasn't changed. And you're also able to take 25% as a tax-free cash sum, but you don't have to take this in one go. You can take it in stages. They've also introduced over the last few years new ways in which you can take your benefits. So it's possible to plan an extended tax-efficient extraction from your pension, and it's really important to take sound advice to make sure you are taking your benefits in the most tax-efficient manner. Possibly one of the most powerful introductions was the ability to pass your pension on to your loved ones. Gone are the days of having to buy an annuity, and meaning that on your death, then your pension died with you. You can pass that pension tax efficiently to your loved ones. But as I say, the biggest benefit is the tax relief available to you on contributions. If you're a basic rate taxpayer, your tax relief in making contributions equates to a 25% return on your investment. If you're a higher rate tax payer, for any contribution that you make, it relates to a 67% return on the investment you make, just for that tax relief. When we get to an additional rate taxpayer, that return is 82%, just for making a contribution to your pension and receiving tax relief at your marginal rate. Now, for a few of you who fall into that category of just earning over £100,000, then you'll know that you lose your personal allowance. Now, for making a pension contribution within this bracket, you not only get your tax relief, your higher rate tax relief, but you also can reinstate your personal allowance. Now, that effective rate of tax is 60%, which means for any contribution you make within that bracket, your actual return on your investment just from tax relief is 150%. So you really should consider very carefully making pension contributions if you're in that barrier of the 100 to 125 or so £1,000. Again, really essential that you take sound advice to make sure that you're making the most of that relief available to you. So there we go. That's just a little bit about our the benefits and the need to plan appropriately. The important thing is you've got until the 5th of April to make any pension contributions that you want to get tax relief on for this year's income. If you don't use it by the 5th of April, then you will lose it. Sam mentioned that you can mop up unused allowances, but you'll only get relief on the tax for this year, the current year that you pay that contribution in. So it's really important that you take advice and get it done before the 5th of April. So on behalf of all of us at Argent, we're delighted to help you if you've got any questions or queries with regard to making contributions. And we hope that you're all well and you stay well, and get in touch if you need some assistance. Cheers, guys. Thanks very much.
Cheers.
Thank you.
Bye.